Now let's take the conversation forward. Atul, we've seen perhaps, like they say, all shades of emotion in 2020. Fear, FOMO, greed, euphoria, and a touch of excitement. What do you think will be the dominant market behavior or emotion for 2021?
I think, Nikunj, all eyes will continue to be on global liquidity. Whether you like it or not, we may try to rationalize and find reasons why something is going up or something is going down in India. But the fact is that what is driving our markets is global liquidity. And a case in point is what happened last Monday. In a tsunami of FII flows that we are receiving, which is fantastic. Last Monday was a shocking day where the Nifty, I think, fell almost 400 points. And we had a sell FII number of only 300 crores. And that actually gave you a sense of what is driving the market. So FII flows are driving the market. And as and when they turn negative, you will notice that our markets also take it on the chin. And that also was a day when you really realize that what are the individual strengths of stocks and sectors. So you'll find a lot of fancy names, which a lot of retail traders are, and there's a lot of retail activity right now, is chasing or down 10% and things like that. So the fact is that the reality is that we are in a situation of massive FII flows. It is not just happening in India, it is a very big flows that are happening to emerging markets, which is a part of a total risk on trade globally, whether it's EMs, whether it's commodities, and you are seeing that kind of play. So for me personally, that is the driving area, and one doesn't know. It can go much longer than most people think about it. That is why domestic investors are skeptical. And, apart from our talk, the flows, you cannot deny those numbers. I mean, last month we had record FII inflows and record DII sell. This month also, we've got almost around 45,000 crores of FII inflows and 35,000 crores of DII outflows. And when I speak to individual investors, which I do day in, day out, very regularly, I find that the level of skepticism is very high. There is total disbelief in the market. But George Soros also said that bull markets are built on walls of worries. And this is a perfect cocktail. Walls of worries, and the market keeps climbing up. People keep waiting for corrections, which does not oblige.
But where is the worry? Atul, I look at all brokerage reports, they are talking about a bright outlook for 2021. In the month of April and March, there was a scramble to come up with a Nifty target, which was the lowest. Now there is a scramble to come up with a target, which is the highest.
Right.
Things are looking up if you look at commentary from the auto companies or from brokerages. So, we may argue about the market behavior because everybody is feeling left out. But in general, the fundamental narrative has definitely changed.
Yeah, you can see that. And, there are a lot of sectors which also what happens is that when you have a risk on trade, the riskiest sectors and stocks also do well. So if you look at the performance of whether it's a sector or a stock, you find that there is a total divergence, that stocks that did well in a year prior to COVID have actually underperformed post that, and vice versa. So if you look at the last 3 months, the best performing sector is maybe reality or maybe metals, which is, I think, up almost 40% plus in the last 3 months. These were sectors which have not done well for almost a decade post the 2008 fall. So what you are having is a very big trade that is happening, a big risk on trade, a revival trade. And yes, at some places you're also seeing, as you rightly put it, Nikunj, that the numbers have started improving. So select auto companies, select real estate plays, the numbers are improving. And you'll find that those stocks actually are leading the rally. But again, I want to reiterate that there is a lot of retail, a lot of new retail investors who've come in. In COVID, people are sitting at home, and thanks to online trading, which again, you can see in the number of new demat accounts, a lot of retail guys are out there and punting. And that is something that is, a bit dicey, because you will find that they will never be in leaders. They will never be in quality. They always look for the single digit or 2-digit stock, which will double in a week's time. And that's where I think the risk is. But personally, for me, we've really stayed away from that space of the market. The risk is you feel a bit left out when you see some very sharp moves. But having spent many cycles, many years in the market, one realizes that you have to be sensible about it. There may be short-term pain or a feeling of being slightly left out because you are not in one of those crazy stocks that is doubling. But when markets correct, believe you me, we saw a small preview last Monday. That will not be good for many of these retail guys who are punting online and very, very new to the game.
So what, to your mind, should be a very basic and a practical approach for those who are either bought into mid-cap stocks or planning to buy into mid-cap stocks?
I think as a trader, I mean, because these are all guys who are trading, clearly the risk management is very important. They really do not understand the fundamentals of these companies. It's always a friend's phone call or a WhatsApp forward or some broker has punted on it. So they really do not know much about the fundamentals, about earnings, which are the ultimate drivers of companies. And that's how a seasoned fund manager would look at it. However, they must have very good risk control. And for risk control, if they're using price as a matrix, there is nothing but having stop losses. I know that's a horrible word. People hate it. A lot of stop losses got triggered last Monday and the market went ahead. So people don't like this word. But the fact is that that's the only way. Over years, I have seen that traders have been able to survive. Otherwise, this market can be ruthless and it will not give many people a chance to exit. So I feel that if you're only looking at price, then please use price as a trigger for a stop loss. For investors, for people like me, obviously, that is a temptation we stay away from. One has to understand that what are secular trends? What are larger trends? How is the world changing post-COVID? And one has to patiently be invested in the stocks because sooner or later you'll realize that that is where the wealth creation happens and that's where the big opportunities are in the market. So I think I'm very bullish on the market in the longer time frame. Short term, there is a little bit of froth, but I still feel that stocks are driven by earnings and one should not compromise on that. One should buy really good quality companies that have proven earnings over cycles, pre-COVID, post-COVID, whatever the time frame, and be able to ride them. So that is really my understanding, my philosophy, or after 30 years of being in this market.
Atul, talking about earnings, where do you see the potential for surprise as we head into the new year and the first lot that we're going to see? Given that we've already, for example, seen strength demonstrated in the likes of an IT, and we'll talk more about that. But apart from just the low base effect, where do you actually see possibility for a strong set of earnings or strong growth delivered? Let's say, in the better part of the year, the early part of the year.
Where I find surprises, and it's in a very beaten down space, is real estate derivatives. In other words, there are companies that are helping in home improvements and things like that. So you have tile manufacturers, you have cable companies, you have various such plays that are happening, pipe manufacturers. I have a feeling that they are going to see a very big upsurge, and that's, mind you, a very big sector. I mean, it's a very large footprint. And the beauty is that here you have a lot of good quality companies. There are companies that have proven themselves. And with all these, curbs on imports from China, I think that the domestic industry here will really flourish. Another area which I feel, again, linked to it is housing finance. This is some place where we have actually taken a fresh allocation in our portfolio. We feel that housing finance actually has the best of both the worlds. It's, of course, the financials, the NBFC side of it, but you cannot distance a real estate revival from funding or financing. In fact, that is what the trigger is. And if you look at the space or you look at the market, you'll realize that among the top 5, 2 or 3 have been eliminated. So here also we find that there's immense quality available. And we feel that this is a case of a sector, a space, which can be a very, very large trend. So we have made moves in this space and allocated some money to one of the best, or probably the best housing finance company in the country.
Okay. Okay, those are some great ideas, as always. Atul, you always share with us, some of those niche, ideas that you're tracking in the market. What about the bigger basket of financials as a whole? And we've discussed this, of course, in the past several times. But there is an expectation or a hope that we'll now start to see that catch up, that we'll start to see that move in line with an earnings recovery or an overall economic recovery in the first half. Do you agree with that? Do you see that happening, or do you feel it might still be a little bit of time before we actually see a meaningful revival?
So I'm honestly not very, very gung-ho about banks and financials. In fact, in our PMS, there has been a little bit of an underweight stance that, of course, has caused short-term pain. But where we find ourselves, or as I tell people, that my overweight area or my NBFC is specialty chemicals. This is one area where we have had a massive overweight allocation compared to any benchmark or anything what anyone else has. And we think that that's the way we think. We actually look at trends on 3 to 5 year basis. It's not about 1-2 quarters of earning. And we feel that specialty chemicals or related plays that are there, which is almost like the next IT wave. It's what we experienced in India, almost a new theme, a new sector, which continues to perform a few decades later also. We feel that specialty chemical and all these API manufacturing and related areas, contract manufacturing, is going to be a very, very big space for us. So that actually is what takes away a very big allocation of our portfolio. And the reason we do that is we are not here for 1 quarter, 2 quarters. We are here for multi-year trends. And in the lifetime of any investor, if you are able to get 1 or 2 such large trends, the wealth creation impact that happens is massive. So at Marathon, we have a very, very strong bias towards specialty chemicals, API, and related plays in the market.
And Atul, for a while, you've had the same conviction for IT as well. And last week, one was, reminded of the inherent strength and the big macro trade that IT is. I mean, this is not just a revival from the March lows or everyone gravitating towards digitization, but a 14% uptick coming in just the last 1 month for the Nifty IT index, and the kind of large deal announcements and the buyback announcements that one has seen only builds a conviction that IT is a story which is here to stay for at least 5 years.
So IT again has been a secular trend and another overweight space. But even in IT, Aisha, what we have done is we've not really gone in for the vanilla large contractors, if you would like to call them. But we feel that the whole platform business is very interesting. And, there are a few listed spaces, not many, very few, which are in this business of cloud, the platforms that are available. And we have, again, an overweight allocation there. Unfortunately, a lot of these companies are in the unlisted space, but there are few that are in the listed space. And I think that this is going to be the big business. In fact, the biggest business beneficiary post-COVID is going to be the whole digital space. And we are, again, overweight in the digital space in the Indian context. Unfortunately, the number of companies are very few in the listed space. There's a lot happening in the private equity space. But whatever there is, we have them. And we really, really are very optimistic on that space or that sector, again, on a 3 to 5 year time horizon, because we feel that it's again going to be a mega trend as far as we are concerned.
Atul, the big quandary now is within banks, because, there is a faction of the market which believes that, it's maybe PSBs or PSU banks which are going to give you a bigger move as opposed to what the private banks have. And, it's not going to be HDFC banks or ICICI banks or Kotak, but SBI could be the dark horse, and that could give you the returns that you want in the next 2 to 3 odd years. What is it that your reading is between this entire private banks versus PSUs debate?
The base engine of markets is earnings. And I still don't see that happening. I still see the risks, unfortunately, the way they are modeled, the way the models are with PSU banks. There will be very good trades for a lot of people. And I am not in that space. As I said, you have to be in fundamentally good companies. And the day the market is Nifty is down 100 points, then you see really what happens. That's where the men stand away from the boys. And we are here backing men. So in this journey, you will always have some fancy 1 month. Once it will be PSU banks or something else, but you cannot keep shuffling and playing that. The thing that remains, or the thing that remains as a bottom line for us, is that there should be no compromise on quality and earnings. Yes, if the price momentum is with you, so much the better. It's great for your portfolio and for your investors. Ultimately, you need price movement. But the fact is that PSU banks, as far as I'm concerned, still don't demonstrate that kind of earnings or certain, model changes or something that is happening which inspires me. As I said, they continue to be good trades. They will be great for traders, but it doesn't fit into my framework or my checklist of investing. So I still remain overweight private sector banks and financials.
Atul, they say in the market that you should catch them young and see them grow. So while it's good to focus on the men in the market, all the nifty men 10 years ago, hardly few have survived.
So at the end of the day, each one has a style, Nikunj, and each one over the years learns through trial and error. I'm one of those guys who is not about, betting on 10 boys and seeing 9 fail. And yes, one will succeed and that becomes glorious. I prefer a higher strike rate because I feel the risk to the portfolio is less. And that is the mandate given to me by my investors or people I interact with, is that ultimately, yes, we are looking for very good compounding returns, but we do not want massive volatility or very high risk. And what happens is that if you are in this game for very long, you will realize that not making mistakes is the biggest success in this market. So for me, it's about, yes, returns first, but also to be risk adjusted or risk focused. So I am very happy to miss the early part of the bull market in some stocks. But the fact is that once they emerge and once there is a certain amount of certainty, we are in it. As I said, it may not look cute, it may not look pretty, it's not great storytelling, but the fact is that it has lower volatility and it has a better effect on compounding. And that's what we are here to do. I am not here for excitement. I'm here to compound money in the long term. That is why I prefer the men to the boys. Though it doesn't sound cute, but honestly, practically, having studied, worked with the great masters, I see that's how big wealth is created in the long term.
Fair point. Between HDFC Bank and HDFC Limited, where do you think bigger gains are going to be made?
Well, I have both in my portfolio, so I have a vested interest. So it's very difficult to say that. But since you're talking about stocks, please do your own research. Our late edition, in fact, has been HDFC Limited and the housing finance play that I was talking about. I feel both will do well, but with the emergence of the real estate coming out of the dark woods for such a long time, I personally think that the housing finance play would have a little more promise in the short to medium term.
Atul, markets, they always go through a style.
Right.
When markets started coming back in the month of May, IT and pharma emerged as leadership stocks.
Absolutely.
And Reliance, in a sense, was the engine. Do you think the character of this bull market, which could be called as like a COVID-induced bull market for lack of any other phrase,
Right.
do you think the leadership still lies with the Reliance, IT and pharma?
So what you rightly started, Nikunj, with the first line that markets has phases. So markets have phases. If you go back and see, this is very similar to what happened in 2003. We had a big fall in 2000, IT fall, and for 2 years, there was a bigger time-wise correction. And a similar rally, what you're seeing today, happened in 2003 and went on till 2004 till there was some government change, etc. And what you will notice is that the first stage of every bull market is most driven by the most beaten down spaces, what we also called an oversold rally. And that is exactly what you're seeing. If you look at returns, I mean, let's instead of stocks, let's talk at sectors, right? In the last, I think 6 months or 3 months, the biggest gainers will be metals and real estate. These were sectors nobody touched. However, when you go back on 1 year returns, so that means you're factoring in a few months pre-COVID also, maybe 3 months, you'll realize that these sectors are actually still negative on a 1 year basis. So IT and pharma, in spite of not performing for the last IT has done, pharma has not, but on a 1 year basis, the pharma index is still up about 20%. So the fact is that there are phases in the market, there are few months, few quarters, and few cycles, but one has to look at the market beyond that time frame, Nikunj. So that is why you have to be able to differentiate between what is your time frame and what is your risk profile. And once you get that, then you really are able to align. And in this journey, we will have few weeks, few months, few quarters also of relative underperformance. But that's okay, because the ultimate game is to finish the race and to be a winner, which is hopefully for all of us a longer time in our lives. And that is what the whole wealth creation journey is. I mean, I was seeing this fascinating diagram, and I hope it's true, that if you look at the most spectacular or famous investor who is almost in his 90s, Warren Buffett, his biggest wealth creation has happened in Apple. And that is a stock he got into a few years ago. So what you really see, a sector which he says he doesn't understand much, technology, a stock at lifetime high, a stock that has never been cheap. So what we really see is that every style will have its cycles. But however, if the philosophy or if your core principles are based on sound understandings or sound experiences, I think that in the long term, you will create more wealth. So there will be multiple cycles. There are multiple quarterly results to create yearly results, and there are many yearly results to create a decade of performance. So these cycles or these trends will keep happening. You will sometime have PSU banks, you'll have sometime metals, sometime real estate. But you really, as a long-term investor, have to look at, boss, 3 years, 5 years hence, where is it that I am able to actually sit through investment, and that really becomes a multi-bagger. So that is really getting down to the simple, very cliche term of power of compounding.
Atul, I can't help but ask, but talking about Apple and Tesla and so forth, would you say it's it would be the right thing to do to have some amount of investment in big tech at this point of time? I mean, why limit yourself just to the Indian equities? Is that something that perhaps people should look at, or investors should look at a little bit more seriously?
Absolutely. I mean, if you look at the last 1 year, the Nasdaq's up around 45%. And of course the Nifty's done very well on the bounce. We are up 14%. So definitely now, thanks to a lot more platforms being available, people are able to allocate money overseas, and one should do an allocation to maybe direct equity if you're so smart, or maybe a sector ETF, or maybe a countrywide ETF. And I feel that the future, I mean, coming ahead, how I see markets is actually in the emerging market space. Interestingly, we are a subset of that. But if I were to look at global markets or look at global investments, apart from tech in the US, of course, I feel that the most interesting space or the most promising space is the EM space. I'll just take a step back and just share with you that the MSCI Emerging Market Index has yet not taken out the 2008 top. Of course, that is thanks to China. But the fact is that this is one space, we are talking about underperformers doing well. One of the biggest underperformers for almost a decade has been the emerging market space. And I feel that very shortly we are going to go and challenge and create new lifetime highs. And when you have a sector or a theme or whatever, a concept that has not done well for a decade, and when you have breakouts of that space, you will find that the rally is massive. So speaking about global markets, yes, technology is what I love and I back, and I think it's really changing our lives, and that is where we are committed or demonstrating it even in our portfolio as an overweight space. But I feel that people investing globally should look at emerging markets. And the good part is that India happens to be a part of that. That to some extent explains the FII flows also that are coming in. So hopefully we would find ourselves in the vortex of the right storm this time. And if you ask me my global bet, it's EMs as a space where I would like to look.
Atul, season greetings and have a wonderful 2021.
Thanks everybody, and hope we have a better 2021 in terms of safer and healthier times. Thank you very much.